Ladies and gentlemen, good day and welcome to the Mahindra Logistics Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shogun Jain from SGA. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone, and thank you for joining us on Mahindra Logistics Limited Q1 FY2024 earnings conference call. We have with us Mr. Ram Praveen Swaminathan, MD and CEO, along with the senior management team. I hope everyone has had a chance to view the financial results and investor presentation posted on the company's website and stock exchanges. We will begin the call with opening remarks from Ram, followed by a Q&A session. Before we begin, I'd like to point out that some of the statements made during today's call may be forward-looking. A disclaimer to that effect was included in the earnings presentation. I now like to invite Ram, MD and CEO of Mahindra Logistics Limited, to make preliminary remarks.
Thank you, Shogun, and good evening, everyone. I trust you all have had a chance to view our presentation and financial results, which are available on the stock exchange and our company's website. In the interest of leaving more time for questions and answers, I'm going to kind of keep my update short. I will provide a short update on the external environment, our end market performance, a few key business elements and events for the quarter, including the status of the ongoing integration of the Rivigo PTL acquisition. And finally, I'll conclude by discussing highlights of our financial performance and our focus areas for the remainder of the year. From a broad macro perspective, the economy of India has and continues to see a tremendous transformation in recent years, and the momentum continues to remain positive. As evidenced in the recent visit of the Honorable Prime Minister to the US, the centricity of our nation as an economic and geopolitical force continues to grow. This growth, of course, will continue to drive the need for increased logistics. The drive for global competitiveness will not just require infrastructure, but favorable policy and more integration across the supply chain. Over the last few years, our company has been motivated by a mission to offer integrated, tailored logistics and mobility solutions using a combination of technology, people, and process capabilities. We believe this customer-driven approach will help us achieve our objective of revenue of 10,000 crores in revenue and class-leading financial returns. During FY2022-23, we took several steps to accelerate our pace of growth and drive scale and synergy in this pursuit. Our acquisitions we made last year were aligned in this direction, and a combination of scale and structural cost management augments our focus on growth and expansion of offerings. Let me go into a quick update on the end markets which we cater to, and begin with the automotive sector as always. At a broad level, the segment, especially PVs, both ICE and EVs remain robust, though some segments are showing signs of moderation in volume growth. Demand has remained mainly stable across all the segments except for interior PV and two-wheelers products, which are not showing any immediate signs of a significant rebound. Despite modest progress in just finished festive and marriage season, demand in the two-wheeler segment still currently remains quite subdued. There are some early indicators of possible headwinds, indicators of demand slowdown in specific categories such as LCVs and tractors as a result of increasing inflation and interest rates. Slightly weaker global macros prompting new demand concerns for businesses with global exposure. The passenger vehicle wholesale sales rose by 7% year-on-year, driven by new product launches and easing supply chain issues, whereas sequentially dropped quarter-on-quarter owing to price hikes, both OBD2 regulations and some weakness in the entry-level segment. We continue to expect growth in this segment from our business's perspective, but do expect to see some moderation in the second half across both auto and farm businesses. The consumer durable business, unseasonable rains across the country appear to have dragged on total RAC demand. However, some areas such as South and East have performed well, Demand from North and West continues to be below forecast for the clients which we work in. That has resulted in higher than normal channel inventories. Weaker consumer emotions due to inflation have continued to affect demand, particularly for entry-level products. And this has been a challenging summer season for cooling products especially. We've seen a strong April followed by some pretty strong weakness in May and some rebound in June. We do work with a series of clients in this segment, and we expect here that growth will be quite moderate for the rest of this year. The FMCG industry, the quarter is expected to be a better quarter. The stress in demand in semi-urban and rural sectors appears to have bottomed out. There's some easing in inflationary pressures. Despite this, obviously there is skewness towards smaller pack sizes across the board. The harvest season following the monsoon were an important indicator for consumption demand and determine the viability and fruits expansion of current green shoots evident in semi-urban and rural markets. Urban markets remain resilient and continue to grow gradually. With a good traction in urban markets, a bottoming of rural softness, and a broader base beginning to improve, overall volumes are likely to begin increasing from here. We have continued to see good traction in this segment, with an increased demand for integrated solutions, what we call integrated warehousing and distribution, and several wins here. And so we expect growth both in account and with new account volumes. The e-commerce sector, which is a reasonable part of our demand base, long-term prospects of the e-com sector remain very positive, driven by an increased trend towards digital adoption and greater penetration across both categories and industries for digital platforms. However, the competitive intensity is likely to increase in the short term, with more players focusing across the board on B2C solutions, micro-fulfillment, and quick commerce across the board. Given demand moderation in the short term, there is a marked increase in capacity consolidation, which has impacted warehousing and solutions done by different 3PLs, including us. As we had mentioned last quarter, we have seen a trading impact of this with the closure of multiple sites in our business across several of our customer accounts. In great measure, our continued business acquisition has helped offset this drop in volume. However, we have seen an increase in white space by approximately 500,000 square feet during this quarter due to site closures, and most of those were in the middle of the quarter. Our electric vehicle business-based delivery services remain robust with continuing fleet additions across 19 cities we operate in. We have now expanded to four-wheeler offering, and recently we launched a two-wheeler offering along with the recent peak of a couple of marketplaces. Lastly, the mobility sector. In the mobility sector, the policy drive towards electric vehicles continues to gain traction, with major fleet operators focusing on expanding their EV fleets and targeting probably around 40 to 50% of vehicles to be electric by the end of 2026. This is mirrored by an increased focus by policymakers and authorities such as airport authorities who are pushing towards a broader trend of electrification. And we do expect that this will continue over a period of time. The volume of aviation traffic in Indian airports has increased by 70% between F22 and 23. And in this year, the aviation traffic volume is expected to grow by another 17%. That has a strong impact on our airport services business, which has been seeing a rebound on account of that. We have also seen a continued but marked improvement in return to office across the board, and this has helped our enterprise transport business as well, both through in-account growth as well as the acquisition of new accounts. Collectively, during the quarter, we registered 39% year-on-year growth in the mobility sector business. If I were to sum it all up in terms of broader demand environment, I think the overall environment still remains broadly positive. For the quarter, we did see an uptick in order intake across our third-party contract logistics business, which improved sequentially in terms of order intake despite the challenges in e-com. For the quarter, third-party 3PL contract logistics order intake was around 130 crores on an annualized contract value basis. Obviously, some of that is offset by churn in the e-commerce segment and a couple of other areas. The forwarding business is also gaining volume traction. Sequentially within Q4 and Q1, we did see growth in volume despite the challenge of continued drop in prices. We have seen some key wins there, across the board. We expanded our presence in integrated solutions for India's leading private telecom player, combining both warehousing and value-added services. For a large personal care products company, during the quarter, we have won the integrated warehousing and distribution solution contract for the western region, which supplements the business which we already do with them in the south, with a similar solution format. For a leading global contract manufacturing company in India, we have been chosen to provide 50% of their cross-border logistics solutions. So overall, we do see demand is improving. We've had a challenge, obviously, in the fourth quarter of last year with some slowdown in demand closures, but we do expect to see that picking over the rest of this year, and hopefully the momentum will sustain. I'll talk about a couple of important things before I move on to the financial performance. Firstly, the integration of the Express acquisition from Rivigo. As you have mentioned before, this was a key quarter for the Express integration. We spent the fourth quarter of last year doing planning around the acquisition, and we entered an integration phase towards the end of that quarter. And this quarter, the focus was on integrating both the networks. Through the quarter, I think we have seen our focus on transport cost reduction has been on plan and is moving ahead per our targets. And we have been able to demonstrate and drive synergy on the transportation side, both within the Express businesses as also with the rest of our other transportation businesses. During the quarter, we also invested significant efforts in consolidating the warehouse infrastructure across both networks and aligning the loads on single IT platform. As a result of the work around the transition, we did see some drop in net service levels across our network as we're doing this transition, and that drop in net service levels did see a reduction in volume across several of our customers. In addition, we also shut down some business accounts for strategic reasons on assessing those accounts. A combination of these factors resulted in a volume drop of approximately 25 to 30% on a quarter-on-quarter basis. What we have done as part of the transition is intimate some of the changes in networks to our clients ahead of time. And now as the transition operational issues are resolved, we are starting to see an uptick in that volume again. We expect that this will be recovered by the early part of H2, and we will be back on a growth track at that time. Financial results obviously were impacted by the volume drop as well as the costs related to the integration of both the networks. We also saw a margin increase in transportation cost due to network optimization, but these remain favorable to prior cost structures. And that obviously had a trailing impact on our financials compared to the fourth quarter of last year. On a quarter-on-quarter basis, last quarter we did actually see we did accrue the deferred tax benefit, which we did not do in the first quarter of FY2024. And on a pre-tax basis, results are fairly comparable and slightly better between Q4 and Q1, despite the drop in volume. The other things that we want to briefly cover is our warehousing and solutions revenues. As some of you have seen in the presentation deck, we did report a drop in our warehousing and solutions revenues on a year-on-year basis. And that drop was largely on account of two things. I think first we did see some churn in the e-com business, as I mentioned. We won new accounts, but the net impact of it was marginally down. We also did see an impact on a year-on-year basis of the shift in the business model we do with Bajaj Electric. And that obviously had, and that change contributed to a substantial part of that drop in revenues. We have obviously, we expect that to come back and track through the middle of this quarter because of the new businesses we have won. On the positive side, I think you would probably see a significant improvement in margins in the warehousing business and solutions business as we have really invested a lot more in finding cost improvements and driving optimization and productivity in the network. And those improvements are actually trailing down. And those have been a reasonably large part of the improvement in the financial performance of MLL on a standalone basis as well, right? We have seen obviously some increase in AS116 costs, which you may also have noticed. Year on year, AS116 costs both in terms of the return, the RTU costs as well as the interest costs have gone up. Those are trailing, of course, the increase in margin which we have seen, and those improvements, those are largely on account of a change in mix, as we have had smaller or less expensive warehouses being replaced by more expensive facilities, which also allow us to get better yield and better gross margin, right? And of course, if there are any questions on this, I'm sure I'll cover those in the Q&A. So moving on to the consolidated financial performance, revenue for Q1 F24 increased by 8% year-on-year, right, on an overall basis. Supply chain, including our 3PL businesses, obviously contributed 94% of our revenue. The mobility business contributed to around 6%. Gross margin on a fully consolidated basis for Q1 F24 was 10.5%, up 20 basis points from the same quarter last year. This was despite the impact of the MESPL acquisition. Excluding the impact of the MESPL acquisition, gross margins for the quarter were 11.5%. EBITDA for the quarter stood at 72.8 crores, up from 68.8 crores in Q1 F23, right, in some part impact due to the consolidation benefits or effects of the Revigo acquisition. Excluding the EBITDA loss of rupees 18.5 crores, which was there in MESPL, the EBITDA stood at 91.7 crores, up from a comparable 69 crores for the same quarter last year. PBT on a fully consolidated basis is down from 19 crores to 0.6 crores in Q1 F24, and our PAT was down as we reported net loss, consolidated loss of 8.5 crores for the quarter. Obviously, the impact of the businesses were very different. The consolidated results were impacted differently by different components of our portfolio, and therefore let me spend a couple of minutes just highlighting the component performance. In MLL, revenue for Q1 F24 was rupees 1,051 crores as compared to rupees 1,069 crores in Q1 F23. That included in Q1 F23 we did have the express and the mobility business consolidated inside MLL. Net of those eliminations, the business actually grew by around 7%. PAT for Q1 F24 was rupees 23 crores compared to rupees 14 crores for a corresponding quarter in Q1 F23. It was impacted largely by operating results and to some extent by other income increases. Other income was up during the quarter for multiple set of reasons, including restatement, including some subleases which are now accounted as financial income and a few other asset categories where we saw movements right in there. Lots was up. Revenue was for Q1 was at 77 crores, down compared to Q1 of last year, when it was 109 crores. PAT for the quarter was rupees 1.6 crores compared to 3.3 crores for the corresponding quarter last year. Most of the dip in profits was driven by volume. On a sequential basis, of course, we did show an improvement in revenue compared to the fourth quarter of last year. The express business had Q1 FY24 revenue of rupees 84 crores. As a matter of detail, I would just highlight that this includes almost all the consolidation benefit of both the businesses. In the first quarter of the year, there were some businesses that did not fully transition, but I would say the large measure of it was transition. And this is where the 25 to 30% drop in volume is kind of really affected. At a PAT and EBITDA level, losses for the quarter were rupees 18.5 crores, and at PAT level, losses were rupees 29 crores in the express business. The mobility business saw in Q1 had a revenue of rupees 80 crores compared to and our PAT loss for the quarter has narrowed quite substantially compared to a loss of 2.2 crores last year in Q1. It was at rupees 1.8 crores in Q1 F24. Losses were impacted during the quarter by one-time charges for write-offs on account of one customer, which is GoAir. We do work with GoAir. And as a result of recent proceedings with GoAir, we have, as a matter of prudence, decided to take provisions for the entire receivables which are due from them, and that has impacted our earnings. Excluding that, we would have been at close to break-even for the quarter, which is in line or slightly ahead of what we had expected or kind of given indications on earlier. Reserve revenue for Q1 was at rupees 31 crores compared to rupees 29 crores in Q1 F23, up by around 8%. The underlying volume growth was around 14%, and we did see a drop. We did have price reductions given to clients, which obviously impact our revenue as well. PAT loss for the quarter was at 60 lakhs compared to a loss of 1 crore for the same quarter last year, a 40% improvement compared to the previous quarter. Despite our kind of a tough pricing environment, a huge focus on operational areas, right, and the underlying kind of volume growth actually helped us narrow losses on a year-on-year basis. In the upcoming quarters, we have a second investment tranche which is due to be made, which when made will make ML the majority shareholder of Wizard or Zip-Zap Logistics, as it's actually called. 2x2 Logistics, this is a business which obviously has had consolidated its turnaround compared to last year when we had significant losses in the business. Our fleet's completely up and running. We have completed the modifications of the vehicles and outfitted them both, retrofitted them also for additional features such as drone carrier capability and so on. And now as the fleet has come back to full operations, I think the business has made a profit of around 20 lakhs in the quarter compared to a loss of 2 crores in the same quarter for the corresponding quarter last year. We continue to see headroom in this business. There is still upside in terms of vehicle utilization and in terms of miles or kilometers the vehicles are running. And we expect to consolidate and continue to improve performance for the rest of this year. So overall, I think it's obviously been a mixed bag. Our core 3PL contract logistics business, our mobility business, the 2x2 investment, and Zip-Zap, are all heading in a consolidated, in a structural guide in the right direction, and all demonstrating good improvement. Some of them over multiple quarters, trailing quarters. The loss business, the freight forwarding business is in a challenging environment as prices still remain under pressure. But I think we've been able to offset that with volume growth and still show a net growth. And we continue to be able to extract margins and hold our margins through solution design and by kind of strong account focus and segment diversification. The MESPL business is in a transition phase, and as we think we have done in some of the other smaller other acquisitions, we remain confident about our ability to scale up, and drive the cost reductions in the business. Overall, I think we'll continue to have a strategic focus on developing scale and providing a compelling value proposition to our clients as we try to deliver integrated solutions. We do deeply believe that productivity across the supply chain has a high correlation to how well we integrate the supply chain using technology. And we remain focused on cost management, continuous improvement as we kind of navigate through some of these changes. And we continue to invest in other areas, especially on diversity and inclusion, expanding the talent base in the company. Right, and those are areas which remain a key part of our focus. Broadly, I think those capture the highlights of the quarter which just went by, and with that, I'll open it up for questions and answers. I'll open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. The first question is from the line of Sumit Kishore from Axis Capital. Please go ahead.
Hi, Sumit.
Hi, Ram. Good evening. I have 2 questions. The first one is, you mentioned in B2B Express there has been a volume drop of 20-25% quarter-on-quarter. If you could give us some sense on how the volume growth trajectory in B2B Express needs to pan out in the remainder of fiscal, and how does network utilization need to improve for you to secure your target of becoming EBITDA positive here in H2 of the financial year? That's the first question. Secondly, on contract logistics, the revenue growth of 6% has decelerated, and could you give us a sense of how much potential is there to increase revenue in contract logistics by increasing share of business from existing accounts? So what is the addressable opportunity by increasing business from existing accounts? And how has business development really panned out, or new client addition panned out in contract logistics? That's all.
Sure. So Alok, I'll take the first one probably first anyway. So I think, as I said, and you may remember, I think what we had said, from the baseline of the share of the volume both the businesses had. I mean, at the time of the acquisition, collectively both the businesses had around 420,000 to 450,000 tons of volume. Right, and we needed another 10% volume growth to be able to get 10 to 15% volume growth to get to an EBITDA positive level, assuming that all the cost reduction actually would be in place and would fall through. Obviously, the cost reduction is a function of two things. It's a function of operating leverage and the velocity of being able to get the volumes to do the cost optimizations. Where we are right now, obviously in fourth quarter, we did see not a 20-25% drop, actually 25 to 30% drop in volumes. As I mentioned earlier, we have not seen any customer really churn out of the system. We've actually, all our customers are still working with us. And many of them are working with us on some lanes and not all the lanes, because as we made the network changes, we intimated to them and worked with them to clarify to them that there will be drops in NSLs in specific areas definitely. And so customers did pull some drops off those lanes, but that's something which we are confident will start coming back, because in July we're already seeing that happening, right? So we should see the progression up. So the first milestone, obviously, Sumit, is, so if I had to wrap it up together, we are probably around 35 to 40% off on volume, 30-35% off on volume to be close to the EBITDA level we need to be at. That obviously assumes that we can also execute the cost reduction work along with that volume, right? And that's why I said we expect that in the early part of H2 we should be able to hit that volume. Obviously, clients will obviously take the volume down in a certain way and obviously add it back in a phased way as well. But we do expect that to really get back to that level by the early part of H2.
Okay.
Right. So roughly a quarter is going to give or take a bit of a quarter of an impact compared to where we thought we would be able to be earlier. And it could get better and could accelerate the volume faster, but it's something which we want to be sure the network's redesigned properly the way we want it to be from a long-term perspective. Right.
So a quarter's impact would be basically Q3 now instead of, so in H2 we should think about more like September to December quarter.
No, I think you should say H2 will be September to December quarter, somewhere in the middle of that. Obviously, it's festive season, so we expect volumes to be particularly beneficial for us during that period. But the network configuration has to get done, and obviously we have to get all the cost bases aligned, right? And so there's a bunch of work there, but we are pretty confident about, we're reasonably sure, because volume has started coming back in July. And that I think is actually the proof of the pudding is meeting it. So obviously we are starting seeing volume come back. As far as contract logistics demand is concerned, I think you're right. I mean, we've seen across the board the automotive segment overall a 7% kind of growth in contract logistics, 6 to 7%. Automotive and manufacturing have led that growth around 13 to 14% year on year. That's all automotive, including non-M&M and M&M businesses, right? And that's been a positive. That's been the positive trend. Obviously, we have seen the impact of churn on the e-com side, and on year-on-year basis, obviously, Sumit, because of the Bajaj account as well, right? The drop in that. As I mentioned earlier, I think last quarter we had an order intake of approximately 100 crores in the 3PL contract logistics business. In the quarter, so that's the last quarter, Q4. In Q1, we've had an order intake of around 130 to 140 crores. Now, given construction windows are 3 months to 6 months, right? We should expect, so that's the window within which it will start falling into our revenues. Right, and to put this in context, I think we have been targeting a 400 to 500 kind of annualized order intake growth, given the longer term aspirations we have in terms of revenue and results, earnings. So this year, I mean, we have started off well in terms of order intake, but it does take 3 to 6 months to actually deploy these solutions, and that's been the trading impact from the revenue acceleration perspective. So we should start seeing this again in the second half, in the middle of this quarter, starting to get rebalanced in terms of the non-automotive growth starting to come back strongly. Right, we have won, as I said, several accounts for a very large telecom company. We are a key part of their 5G program in terms of warehousing and value-added services and distribution for that. We've also won several other larger accounts for integrated warehousing and distribution. So we expect those to start trailing in between the second half of this quarter and the early part of the next quarter, because those build-outs are all aligned towards the festive season. So that's, I think, where we stand, and then hopefully that'll answer your question.
Yeah, thanks a lot, Ram.
Thanks, Sumant.
Thank you. Any participants who wish to ask a question may please press star and 1 at this time. The next question is from the line of Alok Deora from Motilal Oswal. Please go ahead.
Good evening. So sir, just had one question around Rivigo. So we have seen that again, I mean, the losses are quite significant there. I mean, if we were to look at it, we are operating at around the 20% plus EBITDA loss, 22% EBITDA margin loss. So how confident are we in kind of seeing it like a break-even by third quarter, which you were just mentioning, considering that the feelers we are getting is that there is some slowdown in the express logistics in fourth quarter and little bit in the second quarter as well. Just some color on that, if you could highlight this particular business.
Sure, look, I think first of all, let me answer your question on the more direct part of what gives us confidence, and then I talk a little bit more about more strategic factors here. So I think, as I said, when we set up the transaction and we talked to I updated all of it at that time as well. And as I mentioned just on Sumit's question, we did expect that synergies plus roughly a 15% growth would get us to a positive EBITDA window, and from there on would actually be able to drive broader growth in the business, right? And that was the plan, right? Now, what we've seen is obviously in this quarter, because we have been doing network transitions, which are there, we've actually seen the impact of those network transitions playing out. And what that means, obviously, is we have to reconfigure and rebalance many lanes as we put in shutdown facilities, consolidated facilities, redid the tech platform. And obviously, as we had customers operating on 2 separate tech platforms with 2 different physical architectures, right? One which operated more, the MLL network operated more like a hybrid mesh, whereas the Rivigo network is a pure hub and spoke. And as we transition customers across those accounts, we obviously were going to have things, we had to relay out the entire network. And that physical work obviously has been disruptive and therefore has had an impact on volume. Right, and so the first step, I think, in terms of so our hypothesis still remains the same, that with the synergies and with that volume base, we should be able to, we are confident we can break even. Right, the synergies in turn have 3 parts. It has firstly the transportation cost reduction. As I mentioned in my opening comments, those are generally on track. And we feel those are generally on track even at slightly lower volume base. The second one is the consolidation of facilities and infrastructure. That's also on track. We have done the consolidation of most of the facilities. There have been some one-time costs related to that. There are some short-term facilities that we have had to add as well. But those are directionally on play. Right. The challenge we have, for the large part is just the sheer level of volume drop and the impact of the volume drop, because volume drop by another 30-35%. So that's a big one which we do need to kind of claw back on. What gives us confidence and ability to claw back on? Because we're not actually looking at a whole bunch of new business. We are actually working for the large part in terms of business which was already there, right? Which was already there, and it's business which we had accounts we already have, and as I mentioned earlier on, Alok, none of the accounts have kind of gone. We had probably less than 5% full churn on any of the accounts. So all accounts we're working with, the lanes which we're still continuing to operate with them. So it's not something which we believe is a big stretch. Many of them also accounts of our existing 3PL contract logistics businesses. So that, I think, is somebody to more direct answer to how we will get back, right? Now, a couple of other things I do want to kind of highlight here, and just ensure we share the way we see it, and I see it as management. And the first thing is that if you look at the business actually continues to have positive contribution margins, right? This is an operating leverage-based business, and it's volume-driven, as you all know very well, right? And we don't have negative unit costs on the business. Contribution margins are in the 15 to 17% range. We obviously think they have upside more, right, as we can optimize some of these costs in transportation. But that clearly is the spread, right? So as we gain volume and get productivity to the existing facilities, we should see that multiplier effect coming in, right? And that's one thing I want to highlight, that and just reaffirm that. The second thing I think is that when we did the transaction, I think we also highlighted we believe that we got the transaction at fair price. Right. And what I mean by that is that the transaction, obviously, we indexed in the continuing cost of transforming the network, right, in our acquisition price. And even though the multiple which we paid was probably lower than some multiples that some businesses in the industry trade at, we felt that is some part of it obviously was the investment we had to make. Right. So the price of the transaction did factor in what we expected, and we did say that it took us a year roughly to make this business EBITDA positive, right? So the trading effect has been a little bit longer in the first 2 quarters than probably everybody expected, right? Because now we are seeing the actual impact of it. But as you have shown with the Meru business, or we have shown with some of the other businesses, that we do believe we have the ability to make scale profitable. Right, and therefore that's going to be the journey we'll be on with MESPL as well. But I didn't want to give this first. I wanted to first know what you have to do about the numbers first and what we're doing there.
Sure. No, the only point was that we are down 30-35% in volume, and to turn a break even, we need kind of a growth on the initial volume. So bounce back the entire volumes in 1 or 2 quarters could be a big challenge in a kind of a slowing express market growth. So just wanted.
That's a fair point to look, but I think there's obviously this right in everything. But what I would say first, we are down 25 to 30% on the baseline volume, and I think that's not a end of quarter view, right? That's a full quarter view. So obviously we've been improving through the quarter. As I said in July as well, we have been showing improving volumes on our accounts. So the trajectory is there. The trajectory has to hold clearly. We have to execute well. And that's something which I take on board completely as very valid feedback, obviously, and that's something we're working on. I can't really say that it's all done or it's going to completely happen, but obviously I think as early signs are in this quarter, we seem to be on track. Right, and as I mentioned, it will be early part of H2. It will not be. It will not be in Q2. It will be in the early, somewhere in the middle of H2, I just commented to Sumit. Somewhere in the October to December window when we'll actually be able to get to that point.
Just last question. So in MLL Express, there is a taxation impact. I think around it's what I think. Yeah. What was that related to? Because
so last quarter we took in the fourth quarter, because of the first quarter of the acquisition, post acquisition, we did take a deferred tax benefit on the business, and we had obviously taken that to the first quarter with the clear intention that as the business moves into an integration environment, we will no longer take those deferred tax benefits. And therefore, in this quarter, we actually did not take that deferred tax benefit. And if you actually look at it at a PBT level, despite the impact of the at a PBT level, we actually did show some marginal improvement despite the lower volume compared to Q4.
Right. Got it. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good evening, everyone, and thanks for the opportunity. I have a couple of questions. The first one is around essentially a little bit, confused with the industry outlook that you gave in your opening remarks, where certain segments of automotive, you see a little bit of weakness, demand in North and West remains subdued. E-commerce also, competitive intensity short term is expected to result in demand moderation. Now, with all these headwinds, where do we expect really volumes, coming from? Or what is the kind of industry growth that you are looking in your key segments, not maybe in immediate terms, but for the better part of FY24? That is the first question.
Sure. That's a great question. I'll come back and reframe that to my comments just to help clarify that.
So the second question is essentially if you could just quantify this impact of Goyer, the one-time loss that we took.
Sure.
More of a bookkeeping question.
Sure, absolutely. Good question. I'll take the bookkeeping one first. Always easier. So we had pending receivables of around 2.5 crores. 2 to 2.5 crores. We can send you a more exact number if you reach out to the investor relations team. But somewhere between 2 to 2.5 crores was the receivables due from Goyer. This is for largely we are providing. These are the services which are providing largely for their crew and their staff. Obviously it had its own, it's DSO or receivables for several months. Right, and therefore what we have done is on a prudent basis is to actually obviously take provisions against those, right? Because while we're working with the arbitration and the process in terms of finding resolution towards it, we have taken prudent action on that, and that's why I mentioned earlier that net of that we actually were pretty much close to break even at a PBT level in the business. The second thing which I think was in terms of the demand scenarios, I think let me just contextualize this a little bit. So for us in the automotive industry, firstly, our larger exposure in the auto and farm businesses is to passenger vehicles and commercial vehicles. We don't actually have from a downside perspective. Amit, we don't have a large amount of volumes in the two-wheeler business. We have specific accounts which we work with, especially on the electric vehicle side, and some accounts on the bike side. But our larger exposures or larger relationships are in high-end passenger vehicles, both Mahindra and non-Mahindra, and commercial vehicles. And those segments are showing some moderation but continue to be robust. So I just want to clarify that part of this volume growth we expect to happen for existing accounts is because the accounts we work with are actually in fairly robust shape, right? While there might be slightly puts and takes across other parts of the segments, we work with, which is Mahindra, Hyundai, right, BMW, Mercedes-Benz, right, all of those, Volvo. I think most of those accounts are actually still seeing fair amount of robustness. Ashok Leyland, right, Eicher. So we are still seeing robustness there, both passenger vehicles, trucks, HCVs and buses. So those are actually, I think, why we are optimistic about our volume growth despite some of the headwinds I had mentioned in my earlier comments. E-commerce is seeing some softness, and that's a cyclical thing. We've had some strong growth in the market over the last 3 years. We obviously will have corrections in markets. I think for us what's really important, what's actually growing is right now discrete manufacturing, which is general manufacturing is seeing some strong growth. And the consumer, the FMCG business especially. So as I mentioned in my comments, durables is kind of yellow or flattish. Right, auto is still good for us. The places accounts we have are seeing volume. E-commerce is kind of yellow to red. It is obviously under pressure. But the consumer, FMCG, FMCG and general manufacturing segments are up quite a bit. They're not all because of not because of existing accounts alone. They're also because of new accounts that have been winning. I hope that clarifies, kind of our view. But I think if you go back to the fourth quarter where I gave comments and an outlook for the full year, and I did say that this year overall we expect to have slightly slower growth, right? And I think I still reaffirm that view that we will see, the comments we made back in April, we still believe largely hold true. It will be a year of slightly slower growth on a blended basis from a revenue perspective.
Yeah. Okay. Thanks. Just one follow-up on that Goyer thing. So this entire 2.5 crores you have taken provision on, or there is some?
No, we have taken all of it.
All of it. Okay, great. Thank you, and all the best.
There should be no future impact, no negative future impact.
Sure. Okay, great.
is in the line of Kripa Shankar from Avendus Spark. Please go ahead.
Hi, Ram. Thank you for the opportunity. I had a question on the warehousing piece of business. While you've not provided the space entirely manages roughly about 19 million, you did highlight that there was about 5 lakh square feet reduction. How do you see the warehousing space addition going ahead, or perhaps the warehousing piece of business this year? And because I do see that the overall margin profile of the supply chain business, the 3PL contract logistics business has been improving, and just wanted to check if there is further avenue of improvement in that particular segment.
So I think it's a good. So first, hi Kripa.
Hi.
I think let me just to frame that. I think improvement in supply chain business has been a couple of things. I think we have seen where we have just our pure warehousing businesses. We have made a lot of focus on this productivity improvement there, and there's been some yield obviously coming from that. Some bad accounts or poor yield accounts have obviously kind of been shut down. That helped as well. And the third one is where we have been integrated solutions. We have been doing a lot more of cost extraction between the warehousing and the transportation basis, right? And so that's been the three big levers on which we have been working on. I think that focus will remain. I don't think that changes. Now, how to exactly quantify that? I think it's hard to put a specific number around it, right? But it's something which has been a focus for us, and it's finally starting to bleed through our numbers. I think this quarter will probably be more stable. But you saw we did some improvement in Q4 of last year, and we've kind of had an improvement now. And the contract logistics business actually has been improving roughly for last 3 or 4 quarters, quarter on quarter. It's not just one quarter's result. Now, in terms of the warehousing business itself, I think we are at around 19 million square feet of managed space. That includes 1 million square feet roughly, which does not turn into directly to our revenue line. So that's roughly 1.3 million square feet is what our express businesses use. And that's the business, that's the volume which actually gets shown up in the express revenues. It doesn't actually show up against the 3PL revenues as such. Kripa. And I think as I mentioned the press release, we are on track for expansions. We are not. We believe that there will always be some white space. A little bit of white space will be in the network because we're reconfiguring customers, we're adding volume, and actually it's good to have short cycle capacity. Right, India is a short cycle market for the large part, and therefore it's a good thing to have some amount of short cycle capacity. So, so for us, the important thing is to get the revenue yields right on the square feet which we are selling. Right, even if there's a little bit of white space. And so I'm not particularly worried about the 500,000 square feet of white space which is there. I mean, we are working on contracting down to the right yields, and that focus will be there. And the addition of new facilities are all on track. I think we mentioned this in the press release. We have a 1 lakh square feet expansion in Nashik, which is on track for Q3 of this year. We have 2 large facilities coming up in Guwahati, which is the largest in Assam, which is the largest kind of facility in the northeast. We have an expansion, a new multi-client coming up in Calcutta, and one coming up in Lucknow, if I'm not wrong. And all of those, and then of course we announced a Chakan facility of 1 million square feet, of which 500,000 will come by the end of this fiscal year. And all of them are on track. There is no delay in any of them. We plan to take possession of all of those on schedule, and we have a pipeline for all of them. Some of that's basically reconfiguring our existing customers into those accounts, and some of it's new clients and new operations.
Got it. Thanks, Ram. So my second question is that I did note that in the presentation you have stated that you are targeting 18% ROE by FY2026. Now looking at the growth trajectory, given that this year is going to be relatively slower, I think, with respect to overall growth. So what sort of a revenue CAGR are you targeting perhaps over the next 2 years? Because why I'm highlighting this is because we are seeing that the worst is more or less baked in, and from here on you perhaps starting in from FY25, you may see that the growth trajectory can be quite strong. So what sort of a revenue growth target are you expecting over the next 2-3 years?
I think we're looking at, so that's taking guidance and, we don't generally give guidance, right? But I think, I've said this earlier, that we expect to grow the 3PL business at mid-teens, right? As you know, there are two big plays in our portfolio. The first one is getting the 3PL business operating at that, at the 6,500 crore-ish level and actually at the right yields and earnings levels. We've built the scale now. Last year, as I mentioned, at the end of Q4, we have built a point of scale to drive optimization. Right, and now we are looking at a mid-teen kind of growth every year. Kripan, we have fairly good confidence that will hold. Right, there will be a year when it's probably going to be a bit slower like this year, but it will bounce back. We've had, when e-com is growing, it's going at 30-40%. It's not always going at 7-8%, right? So I think it's an issue of how networks can build out. But that's one part. The second part actually is growing the network services businesses rapidly. And the first step in obviously is to get their cost structures and earnings to the right point, because then they actually are scalable. So if you look at our network businesses, I think I think the large business, the forwarding business, is from a margin profile and returns profile that this has to be scaled up now. The last mile delivery business, we put a lot of effort last year and this year to get the margins up. If you remember, Kripan said that we don't think this will be a 14-15% margin business. In the medium term, probably 8% or 9%, and we have to manage our cost structures to be able to get positive yields there. But we're getting close to that point now. Right, and it's a clearly differentiated mode with a lot of focus on electrification. The MESPL business is the one which we really have to get the margin profile of it right. Once we get that right, we can scale it up, right? So that's what I think is key. And then if we are able to get the right margin profile, unless you have very unfavorable macros like we are seeing in forwarding now, where prices have gone through significant correction, I do believe that the growth is something which you can really demonstrate. Even the forwarding business, you go back 3 years, the CAGR is around 25%, despite the price corrections. Right? So it's something which is about our ability to just sustain that growth, and we still remain committed to that. I think obviously, will it happen exactly by the window we kind of set as an aspiration? It's not, it may or may not happen, right? But then if the numbers are actually completely possible, then it won't be an aspiration. Right? So it's a bit of a chicken and egg thing, and rather go long, right, on it. And so we are still not, as we stand, even continue now giving focus on trying to drive to that result, that point.
Got it. Thank you and all the best.
Thanks, Kripan.
Thank you. The next question is from the line of Jainam Shah from Equirus Securities Private Limited. Please go ahead.
Yeah, good evening, sir. So my question is related to just a bookkeeping kind. So can you please bifurcate the SCM revenue between Mahindra and non-Mahindra businesses?
Yeah, the Mahindra business revenue is on 53% of the SCM revenue, I think 51% overall.
Okay.
51% overall is accurate. It is 51% overall, so we do have to index it, so probably on slightly higher obviously on SCM because mobility was 6%.
Got it. Thank you.
Should we go to the next question?
Thank you. The next question is from the line of Saras from Haitong. Please go ahead.
Hi, Ram. So my question is mainly on the mobility business. So can you give us some guidance of how it's going to pan out for the rest of the year? What kind of improvement are we seeing in the reversal of work from home trends? And like you had mentioned about the airport business doing well. So if you can give some numbers or some directionally growth for FY24. Thank you.
Sure. I think from an immediate perspective, where I think the airport business, the growth there is driven really by two factors. One obviously is our in-airport growth, right? And the second one is around expanding to newer cities. Right? For growth in our airport operations, I think we are reviewing our electric vehicle fleet right now because we have to augment it really to drive substantial growth there. But broadly, I think the platform revenue level, as you know, the Meru business has platform accounting revenue, which are different because of the aggregator model we use in accounting treatment associated with that. But broadly, I think at the platform level, we do expect revenue growth to be 15-17% in that range. That's the range it was in the first quarter as well. The first quarter, we obviously saw a substantial amount of growth on the enterprise transportation side. And that's come from two things. One is return to work increasing across some of our clients, and the second one is the addition of new clients. I think in all fairness, I think if I split it up, I think even as we speak now, the incremental impact of return to office is actually lesser than new client addition we had. Right? And one of the things which I mentioned in the past is that obviously during COVID, a lot of people in this industry actually, on the supply side, actually kind of basically exited the industry because the volumes fell off so much. And so as volumes are coming back now, we are seeing several other companies and other mobility companies shut down operations. And that's giving obviously us some headroom in terms of going and acquiring those accounts. So in Q1, I think the bigger impact was probably split halfway or slightly in favor of actually new accounts coming in compared to the just pure impact of return to office. And that should obviously accelerate a little bit, right? So from a full year perspective, I think what we had given as in directionally is that we expect that this year the mobility business will become profitable again on a fully consolidated basis. And that's a turnaround we kind of said we will do. The Meru business we acquired was losing at last 22 crores. 19.5 crores at a PAT level in F21-22, right? So 2021, and we said that we will actually improve it within 2 years and make the consolidated business profitable, and we expect fully to be on track for that, right? I won't give specific guidance as on how much of profitability, but despite what we saw in Q1, we expect on a full year basis the mobility business will turn around and become profitable this year.
Got it. Thank you, that's all from me.
Thank you. The next question is from the line of Ankita Shah from Elara Capital. Please go ahead.
Yeah, thank you. Sir, you mentioned on the B2B express business there is a 25-30% decline in volume. So, and we're looking to turn around this business by second half of the year. So, any benchmark volume number where you think this is required to break even the segment? At what level of volume?
Yeah, so Ankita, I think we have to be, as I said earlier on in my earlier comments, we were around 4 lakh tons, right, on a consolidated basis, and we needed to be around 10% above that to be on a full EBITDA base, break-even basis, including synergy. So we are down around 25% from where we were. So if you do the math, we need around 33,000-35,000 tons of volume. Right, probably around 35,000 tons of volume, and then the synergies to play out. Right, so there is obviously a lot of work going on around that, and through the first, somewhere in the middle of Q3, we expect to be able to get there. Early signs on volume growth are positive. I think Alok had asked a question about what
July.
Confidence in the number. We said I think July numbers are ticking up in the right direction, and therefore we'll have to consolidate and execute better.